This is the second section of the Syndication eCourse. If you missed the last session where we went through the introduction, you guys can get access to that on the other page. But again, this is the Saturday syndication workshop where we spend a little time to go through each of these sections. This time it'll be the understanding the deal, which is more of an overarching type of going through syndication deals, how they're structured. I would say next time when we go over the people and especially the numbers, section 4, that's the real meat of the syndication eCourse. But first, I think the first thing people always ask is like, how are these deals structured? And there are two main ways that syndication deals are put together. Again, syndication is just a word or means of pulling together capital from passive investors. And at that point, you've triggered securities law. And it's very different than just a regular JV agreement, which a lot of people do out there because they're too cheap to put together the documents that is really necessary to make this all happen. Once you do this, it's under the federal jurisdiction of the SEC. And for the most part, there are two different means to make this happen. First, here on the left, 506B offerings, and on the right, 506C offerings. We'll start off with on the left side here. And this is, I've been on the Edgar SEC website, which you guys can get the link there, where it's a huge data dump of all the deals out there. Just probably too many to go through. But the massive majority are 506B offerings, which are more of the traditional kind, where it does accept non-accredited investors, but the general partner cannot openly solicit or market. So they can't put it on like a billboard or radio ad, podcast ad, social media ad. You can take in a limited number of non-accredited investors. I do believe the number is 35. But do know that a lot of these laws are ever changing slightly. Like for example, I guess when we go here to 506C, there are some rule changes coming ahead very slightly. And so the 506C offering is relatively new. It came out with the last Jobs Act 5-6 years ago. This is a small minority of syndicated deals out there. But what it does, it was the government's way of opening things up. So what they did allow was now a general partner could openly solicit their deal out there. Billboard ad, podcasts. Now, the government has given this ability. However, they put a restriction on this and say, if you're going to openly solicit this, you cannot take in non-accredited investors. And the way to think about it is they put it out, they're allowing people to put these deals out there, mass market them, but they want to protect the little guy, right? The guy who is not sophisticated at all and just not a very good consumer to hear a great deal on social media and just invest their life savings. You don't need to really have a pre-existing substantial relationship. But again, you need to be accredited and you have to third party certify. And that adds in another, for some people see it as a little annoying, right? You have to either get a letter from your attorney, your investment advisor, or a CPA. And if you guys want these letters, you've got to maybe pay for some billable hours, or if you have a relationship with your professional, it's just another step. Or the 506B offerings, you do not have to certify at all. It's a self-certify. So, that means that you're the one checking the box. Are you accredited or not accredited? But in the 506B offerings, again, where they do accept non-accredited investors, you don't even need to put that you're accredited or not accredited. You just mark the box that you're sophisticated as opposed to accredited. What sophisticated means for the 506B offerings, there's not a very good precedent set on it. I would certainly say if you've owned rental property before or you're a sophisticated investor, you would qualify for that. But in the PPMs, typically in the subscription documents, you have to justify how are you sophisticated or how are you accredited. So again, these 506C offerings that are mass marketed are really the minority of deals out there. However, it really is like people get it in their head that being an accredited investor is a really big milestone to get there, because they see all these accredited deals out there and they get a little sad because now they can't participate in. But again, what they don't realize is those are 506C offerings. Those are the minority of deals out there. In reality, the majority of the deals do accept non-accredited investors. And that's where it keeps coming back to meeting other people, finding out who are the good sponsors out there. It's your network is your net worth. And this is why we put on events, and we're big on you guys meeting other passive investors. That is why we have the family office Ohana Mastermind group, because a lot of this world that you're coming into, syndication, alternative investments, is heavily impacted by your network. After all, the 506B offerings, the majority of deals out there, the traditional type of deal that's been around quite some time, is quote unquote the country club deal. Another thing that investors talk about, it's one of my big pet peeves here. So I want to learn how the deal is structured, right? And I'm like, what do you mean the word structured, right? Do you mean 506B, 506C? We have some diagrams later on, I believe we'll go through today, where we'll have some org charts. The way the deal is structured really doesn't matter too much. Really, the big thing is how is the deal put together? And this, we go into this section 4, the numbers. What do you look for in a deal in terms of, is the deal being underwritten conservatively? Too many, especially non-sophisticated investors, get all wrapped up in the fee structure, the splits, right? It's important, sure, but that doesn't impacts your returns. But if there's no returns, then what good does it do for you if you're investing in a straight up bad deal from the start? And people always talk about how is it structured. At the end of the day, when you're going into a deal with an operator or sponsor, they should be aligned with your best interests so that you're happy, you get the returns that you want, and you come back to them. The best paperwork in the world or legal documents means nothing if you're investing with dishonest and people without a track record. Again, that's my overarching advices, and that's what we teach about in this type of, especially in section 4, the numbers section. All right. So what I mean by understanding a deal, and again, this is a real high level, right? This is just really skimming. And this is really what you have to do when you're looking at a deal. You typically get the offering memorandum first, right? Or the pitch deck, or maybe a webinar. And you're like, all right, what do we have here? What kind of deal is this? Like I said, syndications can be anything. They can be syndicating a raise for a pizza franchise, a UPS store, some other franchise, or value add real estate, a development, right? It can be anything. So that's what I'm talking about. Like, what kind of a deal this is? What universe are we talking about? And then understanding the risk reward profile. And then what is the business plan? So this section is taken from the Remote Investor Turkey eCourse, which all you guys should have access to. We give it away for free these days. A while back ago, when I first started the podcast back in 2016, we teach a lot of this stuff to younger folks. Obviously, over the years, as I've grown as an investor and our investment group has increased in net worth, nobody's buying rental properties these days because it's just high liability and headache, and you got to deal directly with tenants, and it's just not a scalable way, especially for accredited investors to build their net worth. But there are a lot of principles in there. So if you want to further learn about this, I would say just get through most of the syndication eCourse before you go back into the remote investor eCourse. One of the things we teach there is first evaluating a market. What kind of a market are you going into? And we teach about primary, secondary, and tertiary markets. Primary markets are places like California, where the rent to value ratios just aren't going to work. In other primary markets, maybe Seattle, Hawaii, New York, Miami, Florida, Boston, just not the best places to invest for cash flow. And also, it's a very competitive places there, right? Like Los Angeles, San Francisco, you just have so much unsophisticated dumb money running around buying properties that it's hard for us to compete and find halfway good deals there. I think like Hawaii, like there's somewhere like promoting good deals. And this is like a 3.5 cap, where a lot of the markets we're buying, it's like double that to start. And then there's value add opportunity. The next thing is understanding secondary and tertiary markets. So a lot of times we'll buy deals in secondary markets today. We have done things and we still do things in Huntsville, which is a tertiary market. And I would loosely define tertiary markets as smaller markets, maybe on the 500,000 or less population size. There's still certainly more than 250,000 of population, but I'm just a little uncomfortable with investing in those types of markets unless it's like one of the top 5 tertiary markets, like a Huntsville, Alabama, for example, where you're just having so much undeniable growth. The problem thing with tertiary markets is that they're smaller. They don't have as robust economies such as Houston, Texas, Dallas, Texas, or Phoenix, Arizona. The other thing that I mentioned right here is a lot of investors, when you're getting started, you may look at data from a state-by-state basis or even an MSA basis, such as MSA is like a metropolitan area like Seattle, Tacoma, or the Dallas area, Houston area. And that would be a mistake. What you really should be doing, and what we do, is we look at it from a submarket point of view. For example, like Dallas, there are maybe a few dozen submarkets just within Dallas. And sometimes you're looking at this big data, but there could be hot or cold places within that big state or even MSA or county level. Here's some other things to digest in terms of cities and neighborhoods. You don't want to go into rough areas. When we first started out, we would buy Class C properties, smaller properties, because quite frankly, our investment group was small. We couldn't do as big deals. Our net worth wasn't high enough to qualify for the debt. That's what we did. They are a lot more headache because the tenant profile was lower. And then later on, 2019, after that, we focused more on the Class B properties. And obviously today we're branching out from there. But today, I would be really hard pressed to go into a Class C or low Class B tenant property. It's just a very high likelihood of high delinquency, upwards of maybe averaging 20%. So that means if you have 10 units, 2 of them, you got deadbeats that are not paying. So a lot of that information came from a lot of the buying little rental properties, which most of our investors today just skip over and go straight to syndications and private placements. But I think it's good to understand that stuff to a certain extent. Next, understanding asset classes. So now we're really getting into more sophisticated language that more institutional or credit investors talk about these types of deals. So first, we're talking asset classes. The way properties are graded, not from a neighborhood perspective, but more of an asset perspective. So you have A-class buildings, B-class buildings, C-class buildings. And I would say an A-class building would be defined as something within maybe 20, 30 years. A Class B building would be something a little bit older. So I'd say maybe built 1990s to 1970s. A Class C building might be 1960s and 1940s. So basically, the age really determines that. However, you can have something, and what we've done in the past many times is we take like a 1970s property, which is, I would say, might call that a B-class property. Put a little lipstick on a pig, new flooring, new appliances, maybe do a little bit of exterior upgrades, and now you have maybe a B-plus asset. You can't do too much, right? Unless you're going to do heavy value add, which might mean $15,000 to $25,000 of rehab. And I'm really speaking in generalities here. And that's really the whole point of this section, is to just understand what is the business plan here. A lot of times in the past, we opted for smaller business plans because they're easier to execute, less construction, less risk, less unknowns. And we would opt for a package of new flooring, new appliances, new paint job, something pretty simple, right? Pretty simple to execute. And here would be some examples of the bedrooms. And you can see the new floorings, new fans, obviously new paint job. I think the big difference is in the kitchen. This is more of a Class C upgrade. This was, I think, 1950s, you start to see these yellow appliances here, but you see the upgrade to more of a class B type of standard here. Not quite granite stone countertops. That might be in more of a minus type of upgrade, or an over class B upgrade. That maybe not be the smartest thing to do to over upgrade to granite. But you see that kind of the level of fixtures. A lot of times this can be done for about $5,000 in terms of upgrades. So that's what I mean by throw on 5 to 10 grand and bump the asset class from maybe a C plus to a B minus, right? Half a step. To take it a full step, if it's even possible, might take 20, 30 grand plus. And that's where, as an investor, you need to understand how much cash is being used and what are they taking it up to. And I'll say it's just not possible to take, for example, a class B asset, B plus asset that's 1980s, put a whole bunch of capital in it, and now magically it's an A property. That's just not possible. Maybe an A minus, B plus, but certainly not that big of a gap. And that would be probably signs that the marketing package you're looking at might be a little bit overzealous. As far as a recap on property classes and neighborhood classes, which is down here, this is a great figure to understand. Basically, what it's saying is that there's a nice little sweet spot right under the high-end properties and above the low-end properties. Like I said, low-end properties, you have a lot of headaches. The numbers may look good, but make no mistake, it just doesn't come to fruition, right? Or there's a lot of headache. Some passive syndication investors see it from a different lens. They're like, if I'm just a passive investor and this general partner is the one doing all the hard work, then I feel a little bit more comfortable going into lower end properties. And that's a very valid point. However, you're going to see it come through in your distributions, or maybe in it potentially end and exit. As far as distributions go, when you're a new investor, you look at that quite a bit, but you got to remember, most of these value add projects, the majority of the money is made in the exit. So you can be in a project that doesn't pay any distributions, it runs into problems, but it more than beats pro forma at the end through the sale or refinance of the asset. But typically when you're going into these lower end neighborhoods, it's harder, it's just more volatile, if that makes sense. So other things to look at the deal, right? What is the demands out there, and what are the drivers that's driving that population growth or job growth? Something I always look at when I'm looking at a deal is like, what is that some markets, or if you can only grab the market data, that's fine, right? It's better than nothing, although it's always better to go to the submarket. But what is that market's data in terms of rent increases per year? I always feel like that one indicator is a real quick and dirty way of evaluating a market, because what it really is taking into account is population growth and what is also coming online in terms of new supply and old supply going away. At the end of the day, that's the price per square foot that people are paying for rent. And I always think that is a composite of all these other factors going in: job growth, population growth, and everything. The reason why we like workforce housing, home ownership is dropping. The amount of immigrants we have, it also helps prop up our population, which is also generally growing. Even if the population was going down or staying the same, what I do know is the wealthy are getting richer and the poor are getting poorer, and the shrinking middle class is coming down to the lower middle class, which is the population demographics that we serve in that area. I'll take a quote from the great economist, Peter Linneman, and he says, focus on the long term, right? Something that's going to be happening 5-10 years down in the future. And that's where it keeps coming back to workforce housing makes a lot of sense. And especially in like recessions, things get tough. People start to go after value type of purchases, and their housing is no different. Instead of stretching for that $1,600 posh apartment or single family house that they rent, or maybe they get foreclosed out of their house, these guys have to move back into more value type of housing, and that's where they fall into our realm. So again, when you're looking at a deal, I think it's important, okay, what is the business plan? Is this a yield play where it's more just say the value add portion is relatively small and it's just a good find and you're buying it and it's yield, right? Yielding is a kind of a term for cash flow. Or is it a heavy value add play? Or is it a light value add play? Or is it a full development? Those are four kind of terms on that spectrum. The yield play might be more, you can pick it out as being light on the physical construction, such as maybe you're not going in and there's not a huge construction budget. I would, as a loose general rule of thumb, I would say anything under $8,000 to $10,000 per unit would probably mean relatively light construction budget. You got to also think that you got to have some money going to your exterior type of projects, or if you have a clubhouse or pool or grounds that you want to increase. Like a lot of times we'll add in a playground, or there might be a pergola, or convert old tennis courts to pickleball courts, things like that. A quick and dirty way of looking at just the rehab dollar per unit. So even though you might just do flooring and a refrigerator here, as far as your actual construction plan, and that may be $1,500 to do that, where's the other $2,000 coming from? Those might be exterior improvements. So it's important to understand that. But real high level, which I think is where most passive investors stay, they're at least just aware of it, is construction dollars per unit. When you're getting above 10 grand per unit, and especially in the more expensive areas, I see some value add projects go as high as $30,000 per unit. I think you get higher than that, now you're breaking down walls. And I think you're only seeing that maybe in the primary markets where you really have to get in that type of level of construction. Plus, sometimes it's double the price, or maybe a triple the price in those high price area due to lack of the trades people and just higher costs out there. But yeah, medium value add plays would be probably more on the tune of $10,000 to $20,000, $25,000 per unit. And of course, there can be other ways you can value add, which are not physical construction. Those could mean all the things that are listed here, more like management plays to lower expenses or keep expenses where they're at, or other means to drive up income, or especially other income. These days, and I think I used to live in an apartment, so I think a lot of our investors used to do it. But the one thing that has definitely changed in the last 10 years is the base rent is no longer just the base rent. There's always added, it's like trash valet or this type of service, that it is a little bit misleading, but that's the world that the modern tenant lives in today. And that's other income on the P&L sheet. Back in the day, I used to make a little chart like this. I think I still have it on the investor portal, but it's obviously 2 or 3 times as crowded. But this would be a way of visioning your portfolio. I don't necessarily think anymore that this is a great way of finding where your weighted average is and have it align with what you're looking for as an investor. Like, for example, still today, a little bit nicer, middle of the range properties. So people may call that B plus assets, or at least tenant quality neighborhoods. And I prefer a little bit more heavier reposition, which is why we do developments. But the yield plays, they sound good, right? Because it's less construction, it's less things that are doing. But you really want to get away from that level 1 unsophisticated investor play, which is the buy, hope, and pray model, I call it. In reality, if you're not doing anything to the property, you don't have that level of safety there. I used to do this. I would buy turnkey properties, maybe put a few grand into it for new curtains, fix the doors, repaint it. But technically, that's not really value add. You're just make ready for the next tenant. And when you're doing that, you're not really adding value to the property. And as the saying goes, real wealth comes to those people who add value or create value. But what we're speaking to here is, by you creating value, adding value to the property, and not it being a buy, hope, and pray property or a yield play, you're creating that factor of safety for you. Should anything come in the economy, a black swan event, now you would be a little bit underwater, right? If you didn't add value to it. But if you added value to it, if anything should happen, technically you should have that buffer built in there for you in terms of equity. So if you needed to refinance or anything like that, or this is why you invest in syndication deals, right? Because now you've got somebody flying the airplane for you. So that's kind of why today I would probably be, if I would wanted to be investing, I'd be somewhere in this first quadrant here, somewhere between the B plus and medium to heavy reposition. But obviously, I'm all over the place here. This is an old scatter chart of old deals I've been in. I think this is important to speak this way, right? This is the whole point of now you're aware of these things. It may not work on this chart, but at least you're aware of these things so you can have these informed, empowered conversations with other investors. And that's when you really start to get moving here. Obviously, there's also a nice aspect to diversifying too, right? Across different spectrums. In the pandemic, the Class C properties those tenants were impacted a lot more in the pandemic, right? Because those service sector jobs, the lower paid jobs, those are the first people that get laid off. Traditionally, in normal recessions, like it's the Class A stuff that hurts more, right? Because those people lose their jobs. And then it affects everybody. But then there's this cascading effect down where the Class A's fill in for the Class B's, the Class B tenants move in from Class C's. So I guess the point is you play that theoretical idea, and that's where I'm at. I like Class B plus assets or this workforce housing sector because I like my position should a recession come and people have to tighten the strings a little bit and go after more value play, which is me. Doesn't always work that way. And I think that is also some level of diversification might be the prescription now. So you guys can take a look at some of these videos here. I think when it really comes to life is when you look at the pictures, the befores and afters. But we do property tours once a year. We flip-flop between our geographic strongholds. Last year we did Huntsville. We also took you guys to the new completed development up there. And then I think this year we'll go to Houston, Texas. But I think it comes alive when you are walking through the properties with us. It's also cool to meet myself, the team, and hang out with some of the other investors. Normally we go out to dinner after. You're walking through the property and then you're checking out some of the old units and the new units, the renovated ones, and maybe some of the make-readies in the middle. And you're like, yeah, now I get it. Now I get what I'm investing in. I wouldn't live here, but at one time, maybe in my life, I would live here. And I think even when you walk through a C plus or a B minus asset, that maybe your perception would have been different. But I think generally people come out of that experience where they physically walk through it and they're like, this isn't bad. It's not too bad. And I can definitely see how a stable base needs this type of good value housing. Here we're talking about what kind of things that are upgraded, interior upgrades, exterior upgrades we talked about, but also there's a new rebranding. We're big on reputation online with the Google reviews is the big one these days. Yelp reviews are really manipulated. There was a big scandal with Yelp reviews. You still got to play that game because I think the good portion of people do use that particular review site. But new signage, new name is typically part of the package that we go in with. And then also reducing utilities. We've done some solar in Phoenix, and then generally we always bring in the consultant who brings in the water conservation devices. At the end of the day, we're paying a lot of times the way that's worked for utilities or things like that, unless it's individually metered. Every gallon of water, every kilowatt hour is a lot of times kind of impacts the bottom line for us. But here are things that we look for. I would say a common mistake you see with investors kind of when they first flip through these pitch decks is, wow, this looks amazing. And I think that's typically these pitch decks. I'll give you the industry secret, just stealing the photos from the broker package that got sent to us at the beginning. And sometimes maybe that's not the best thing to be looking for, right? What you're looking really for is that delta between the before and what the vision is of the future. And of course, there's a budget associated. Does the numbers work? But I think that as an astute investor, I would be looking for that delta, the value add between the before and after, and not necessarily how's this property now. It's like a good example that might be more from like a review site, like Yelp. People will go to the property website and they'll look at the reviews, and the reviews will be horrible, which they typically always are in a non-class A type of workforce housing type of apartment because people are cranky and they only complain. And nobody says, I love the $1,300 a month apartment that I live in. Of course, we try to do that, right? We have initiatives where we hire people to come on and create that community. They do events, they go around, they say hi to tenants, they ask what the problems are. I call them cheerleaders. And we've done a past podcast on that consultant in particular. We do like Father's Day, Mother's Day barbecues, or just excuses to do community events. When people are happy, just like, your job, right? People are happy, and when they tend to just not live there because of the rent per square foot that they're paying. There's a sense of community, and that people are looking out for each other, helps with safety too. It's like those intangibles that we really start to develop at the second half of the business plan, where the first half is typically going in and just doing the internal renovations first so that you can lease up the new tenants. And then as you're moving the bad tenants too at the same time, then you're working on the clubhouse, because that's the first thing that new prospective tenants come to. You want to jazz that up. And then you want to pick apart all the exterior improvements at the same time as you're progressing through all the units as you need them, right, as they come up for leasing. And then somewhere in there, especially in the beginning, you're changing out the sign, the logo, and then you progress in that manner. So from generally speaking, you do the interior first and then the exterior improvements to end. Things like re-slurring the parking lot might be at the end, or if you had big deferred maintenance capex like the roof, that may be at the end, or whenever it's more convenient to get the best pricing and the team gets completed with the procurement process, bidding that one out. That's how those projects get divvied out through the business plan. But what's not said there is, as you get new tenants in and you flush out the bad ones, and there's always bad ones, sometimes more than other times, you're just revamping that whole tenant profile very slowly, and it just becomes a happier place to live. And as we go through this, if you guys have any questions, feel free to type it into the Q&A box. Be glad to answer any questions that you guys have as we're going through this. More discussion on workforce housing. What are the markets? Today, we're going off the big overarching thesis that the Sunbelt states are the better places to be investing in these days, due to the general trend that people are moving away from the higher states because it's colder and more into the warmer states. We obviously invest in more red states because we want the landlord laws on our side. And generally speaking, some of these markets, they just are better, more pro-economy, which helps out with the demographics and people having the ability to pay for this type of stuff. Another nuance here, a lot of our tenant profiles, a lot of the good tenant profiles are immigrants. I don't want to go too much further in detail, but generally, like a lot of immigrants, like Hispanic, great demographic, very family oriented, and they watch out for each other. They pay their rent, and there is a very honorable, I call it, folks out there that say we don't invest in the gateway markets, like San Francisco, New York, but more of those secondary gateway markets would be like Houston. I believe like a Phoenix is considered a gateway market these days, but not like Miami. Miami is a gateway market, but it's just too expensive out there. One thing to ask when you're looking at a deal is, the difference between physical occupancy and economic occupancy. Physical occupancy is just, you look down the rent rolls and how many lease assigns to units, or they call it heads and beds. So you can have 100-unit property with 8 of those units not filled, and that's a 92% occupancy. However, there's always a little bit of people who might be using the property, might have a head and bed, but they aren't paying. And this could be fully or partially, but when you look at it from a high level, a lot of times you may run at like a 3% on better properties where you can call them deadbeats for the most part, right? They're not paying their bills, or they pay it late. And I think this is a big culture shock for new investors. When I had 4 properties in Birmingham when I first started, and then 5 in Atlanta, and just out of that small sample size, I always had 1 or 2 people. I had a few people paying with the Walmart money orders. I didn't know you would get money orders at Walmart. And like it was always like one or two of them that would be late. And then they would have to pay $30 late fee or $50 late fee, which I split with my landlord, my property manager at the time. And I just never understood. I'm like, I got so frustrated for them, right? Because you're paying $50 every month or almost every month. Like one lady, she did 5 months in a row paying this like $250. And I'm like, hey lady, that's like a quarter or almost half of your monthly rent with money tight for you. You can't be doing stuff like that. But that's how these tenants are, especially in the Class C sector. And this is, I think, why a lot of investors who've owned rentals move into syndications. But I think a lot of people who just skip right to syndications don't understand this dynamic. Some of the Class C properties we've had in the past, which is why we don't really like to go there anymore, even though the returns may be really strong. Like we would have like Trust Palms, for example, the one you saw earlier. We had 80% collections, or 20% of the people just were late and never paid. So again, you can have a 92% occupied building, but if only 80% of them are paying, your economic occupancy is really the question to ask, right? I don't care how many leases, whatever, how many of the rents that we should be getting, the gross potential are we really getting at the end of the day? Both are indicators, right, of health, and we look at, and I think in passive investors look at, but I just wanted to point out the difference between the two. The economic occupancy is obviously impacted by rent collections, and that's what the property management company is for. It typically looks bad in the beginning, and that's exactly why we bought these properties, right? Especially the Class C assets, which we're trying to stay away from. But that's why the large institutions stay away from this type of stuff. Even these Class B assets, slightly hairy, and it typically can take a couple of quarters to get through that initial stage. But you don't really get through all the tenants in the first year, maybe even the second year, right? Because some tenants stay around. If you remember back when you were renting, you typically moved around from year to year. But some tenants are lifelong tenants where they stay quite a while, maybe even years. And sometimes that could be good. Sometimes it could be bad if they're a bad tenant that you don't want in your. Most deals, they take a couple quarters to kind of turn around. But sometimes your tenant profile can be really bad. I've seen it take a year, a couple of years to really turn the ship around, especially on larger properties. That said, should there may be lower cash flow or no cash flow in that period. But again, you got to realize that the way you're making money as an investor is through that value add where you cash it in at the end. So it is a very delayed gratification game. Sure, maybe you thought you're getting cash flow in the beginning and maybe the deal was marketed that way. But when I go in as an investor, I'm always assuming that cash flow is icing on top of the cake. At the end of the day, that deal, like the value add, you just have to wait to cash in on that hard work and that sweat equity for the force appreciation in particular. And that brings us to great terminology here to describe deals. And when you're chatting with other investors, this is, I think, a great way to discuss. For example, I like the core type of deals, right? These are like the lower, I'm not saying I do, I actually don't. I like the actually more value added opportunistic deals personally. But core deals are the lower risk deals. These are new and like new properties and highly desirable areas. And part of the idea here is you're not getting as much things to do, less value add opportunities, less movement for this thing to go. They're typically good for investors who want stable income and capital preservation. But again, I always feel like that's a false sense of security, because at any time something could happen in the economy. And now if you're in a core product, you're a little bit stuck and underwater. But maybe that's where you want to be, right? In a good, stronger tenant profile and be stuck there. So something can be said for investing in core investments too. And I think don't take what I do as what you should be doing. It needs to align with your investment philosophy. And I'm just using it as an example of how investors will have their slighted to their mindset. And that's great, right? After a while, you will develop your investment philosophy over time. But for now, I think it's just important to understand what value add projects are and what opportunistic plays are. I would say ground up development might be seen as somewhere between heavy value add and opportunistic play. But a long time ago, I thought developments were really risky and I stayed away from them. But what I wasn't able to do at the time, I didn't have the network to figure out, well, who were good people to work with and who are reputable. But secondly, I didn't really differentiate between which deals were just pie in the sky projects and which deals were in the path of progress, kind of no brainers to happen. And were also easy path to permitting and construction and what we call shovel ready. And that's the projects that I like to pick off these days. In terms of opportunistic, the risk reward profile, the returns in ground up development are much higher than value add plays. And I would argue that it's actually less risk because you're not really influenced by interest rates and what happens in the economy from a month to month basis. You basically go in your hole, you got your financing, you build it, and you come back out of your hole 2 to 3 years later and sell it. Or if it's not a good time and it's like the groundhog who sees a shadow, you refinance and you hold it longer term. And I think that's what's nice about the developments. You have that ability to play that groundhog day strategy if you want. And what is better about developments is they don't last as long. There's a quicker velocity of capital. A lot of what I've learned is just seeing like emulating other higher level investors, and they typically like those deals too because of the velocity of capital. But also it's just for the returns that you're getting, it's maybe equal, less, or slightly more risk. And that's what you're looking at as an investor. And I think that's what it comes down to. In essence, this section is talking about what kind of a Sharpe ratio are you looking for? You look up the definition for Sharpe ratio. It's more of a theory, right? But what you're looking for are good deals out there that have a high potential of returns per the amount of risk. I think developments have the best Sharpe ratios out there. Sure, you have to build it, right? And that's unknown and uncertain, but the amount of potential returns is so much higher than any value add project. There is that buffer, that margin for safety. If things don't pan out or there's unforeseen conditions, there's still the ability to still make more money than a regular value add. But I just wanted to throw that out there. And these are just discussions that you have with higher, sophisticated, more experienced investors. And when you speak in this way, at least you're able to speak in the same language. And I think maybe I'll say this multiple times. Once you go through this entire syndication eCourse, you're going to know more than most accredited investors out there. Most accredited investors out there are looking at these deals from a high level. And at some point, they pull their head out of zeroing in even further. And they realize this game is all a relationship game, whether you're investing with the people you're investing with, but what I always say, it's the other past investors that you're meeting. And that's kind of why the network is so important. As far as some people, when they look at deals, they may discriminate. I don't want to invest in Louisiana or Gulf Shores, Alabama. And I think it's fair enough. That said, if you start, every geographic area has something wrong with it, right? So don't always just point to one thing. Maybe for your first 5 or 10 investments, you may be like that. But after a while, once you're on investment 20, 30, 40, you're going to want to go into a Tampa, Florida, or a Orlando, right? I just say those because they're a little bit more prone to hurricanes. But as far as like floods, best practice there is go look at the FEMA 100-year flood map. You can do this due diligence on your own. Or another thing would be in terms of like tornadoes, earthquakes. I wouldn't worry too much about that, right? That's where insurance really comes in. And really, insurance comes in with all of these. And we've had our fair share of natural disasters and a lot of fires. And what I tell investors is, at the end of the day, we're covered. We've got strong commercial insurance, and a lot of this insurance is mandated by the bank. Right? A lot of times they mandate a pretty high level of insurance where there really isn't too much to worry about. It covers lost rents. The thing to worry about is, can you cover the difference in the middle, which is why the need for reserves and working capital, because a lot of times we'll have to front the construction costs, then get reimbursed by an insurance company after the construction, which can range in terms of how quickly they're responsive. We've had it where it's taken months to get a check back. And sometimes, especially when we hire outside claims adjuster involved, to help us, which is common practice for us right today. Especially if a claim goes over $10,000-$20,000, we'll get a claims adjuster involved. Now, one time had a fire. I think the claim was like we got over 100 grand back, but the first offer from the insurance company was like a paltry $30,000, and that just kind of shows the power of these claims adjusters fighting on our behalf who are knowledgeable. And just like how we use lawyers as consultants and contractors and even the property management teams, right? We're pulling together professionals in their respective industries. But sometimes you can come out ahead on these natural disasters where it's like in football where you're the quarterback and the defensive line moves on you and you've got a penalty situation on your hands and basically got a free play, right? So you just air it out and you take your chances. Similarly, we had it where there was like hail and then we got brand new roofs on an entire property. That was cool. Or yeah, we had, like I said, we have many fires. Like one of those fires we had touched some other things that we were gonna fix anyway. So that was very lucky, I guess. I'll touch upon this frequently asked question, the minimum investment. Typically, I think you should be looking for minimums in the $50,000 to $100,000 range, maybe a little bit more these days because inflation. But yeah, anybody willing to take in less than 50 grand, especially like less than 25 grand. Wow, you're probably working with a newer syndicator or operator. I would really question the validity of the track record there. It's just what we found is like we try to minimize our investors to keep it at 40 in a small deal to 100, 150 investors in a deal. It's harder when we're needing to raise more than $8, $12 million. But just we try and keep the investor count small. Institutional operators, people who have 5-10 billion in assets under ownership, they have higher acquisition fees and worse splits. You probably don't want to invest with them unless you're already to end game $5 million and above. But these guys are typically looking at minimums $100,000 to $250,000 minimums plus, maybe even $1 million minimum. For most of our investors, if you're under $5 million net worth, you probably don't want to be investing with more of an institutional operator. But what you're trying to do is trying to find a shop. And I think that's what we are, right? We're the middle market operator. We're not newbies. We've done 60, 70 deals as of 2023, $2.1 billion of assets. But we're not like a fake it till you make it group who I click on some of these social media ads sometimes and I'm like, who is this guy? And he's touting a $300 million portfolio, which isn't very much, right? I feel like we really started to get rolling and cutting our teeth once we got over that $1 billion threshold. But then they're saying they got to fill up that page with some kind of vanity metric. And they're like 35 years of experience. And I'm like, well, that's because you guys have 5 of your partners and each of you guys have only been doing this 5 years. Oh, wait, no, all you guys just started listening to Bigger Pockets 3 years ago. And the 5 of you guys is 15 years. And the other 15 years is coming from this one guru that you paid $50,000 to put on your website, who really doesn't have that much experience or just marketer. One of these many gurus teaching this stuff that doesn't really have any real world experience. And supposedly they've been in the industry 15 years. So they added his 15 with the other 5 guys, 3 times 5, 15. And that's how you got 30 years. Right. So there's all these games in here. And this is what we're going to get more and more into in the next section, the people section, figuring out who are the posers, the liars, the fake it till you make it, and who are the people you actually really want to be working with. And kind of the hint there, really hard to determine this yourself. I've given up. Like, this is why I stopped going to these fake real estate conferences, because a lot of times the people speaking are just marketers. And they are just creating these conferences to make themselves look validated. Where really the only way to really determine things is find other passive investors who've invested with these people in the past. Now, that may not be possible when you're first starting out. And that's where, when I first started investing as a syndication investor, I didn't have that ability. So that's why I invested with a whole bunch of people and on a few occasions lost money and stepped on those landmines. But that's the part of being a new passive investor at the beginning. But that's exactly why you're educating yourself to have a better chance of spotting out those sucker deals. And you're doing this so that you can get yourself up to a prerequisite knowledge level, which isn't very high, but getting you to a certain level where you can have informed conversations with other passive investors and speak the lingo. Oh, I'm looking for core plus. What do you like? And click play that game. And that's where can I find syndication deals? So you can dumpster dive through the Edgar website for thousands and thousands of deals out there, but there's a lot. The crowdfunding websites. Now the crowdfunding websites are broker dealers. They just put whatever stuff on there and who pays them money. Do not consider that as due diligence on, they're not doing due diligence for you. That is your job. We've tried to use crowdfunding websites to raise capital for our deals, but when I saw the price tag associated with them coming in and bringing in maybe only $1 or $2 million for me, which is nothing, I was like, whoa, that's not worth it. And so that from my operator perspective really makes me scratch my head. Who's using these crowdfunding websites? Don't they have investors of their own? Why do they need to pay an arm and leg for them to just raise a 10th or 20% of their capital? Plus, the frustrating thing about a general partner using a crowdfunding website is I don't have access to the people. This crowdfunding website controls the relationship. They don't allow people to come around them for the most part, or they make it really hard. And that's the lifeline of my business. A lot of investors having a good experience with us, sharing it with their friends, and that internal referral system. And I don't get that with the crowdfunding website when I use it. And plus, you can't really raise that much money. The people who invest through the crowdfunding websites, they're only putting down like $1,000, $5,000, that type. And those are oftentimes, at least from the general partner standpoint, the worst investors. With that, if there's any other questions, we can add it in here. But I think we've run up to the end of the section 2, understanding the deal from a high level. All right, pretty easy. This section, it's made to be a little bit of a high level. We'll definitely dive more into it next time. Maybe it'd be good to read the next couple sections ahead. But yeah, we'll see you guys next time. Bye.